You know that sinking feeling you get when you reflect on the past and think, if only I had known this sooner? That was exactly my experience with investing. I grew up in an environment where discussions about finances were virtually non existent. There were no guides or blueprints outlining the process, nor any mentors imparting wisdom along the way. Instead, I embarked on my investment journey through trial and error, which proved to be both challenging and costly. Today, I want to share with you 5 invaluable tips that I truly wish someone had emphasized to me at the beginning of my journey. These insights not only could have saved me countless hours of frustration, but also thousands of dollars that slipped through my fingers due to my lack of understanding. Whether you're stepping into the world of investing for the first time or have been navigating it for a while, I urge you to pay close attention to these 5 key lessons. Implementing them could significantly accelerate your path to building wealth and achieving your financial goals. Reflecting on my financial journey, one of my most significant missteps was the belief that I needed to have substantial funds before I could start investing. I often found myself thinking, I'll embark on this investment journey once I have more money saved up. However, I've come to realize that investing is not solely about the amount of money you have at your disposal, it's fundamentally about timing and the willingness to start. Time is an incredibly powerful ally when it comes to building wealth. The earlier you begin investing, the more opportunity you have for the magic of compounding interest to take effect. For instance, if I had started investing just $50 a month during my earlier years instead of waiting for a larger sum, my investment portfolio today would look dramatically different. Each of those initial contributions, no matter how small, would have had years to grow, multiplying over time. The lesson here is clear. The sooner you take that first step into the world of investing, even if it means starting with a modest amount, the greater the potential rewards down the line. By embracing this mindset, you set yourself up for a future where your financial dreams can actually become a reality. The first time I noticed my investment portfolio experiencing a decline of more than 10%, I felt a wave of panic wash over me. My instinct was to quickly withdraw all my funds and escape the situation. However, this experience taught me a fundamental lesson about investing. Volatility is an inherent part of the financial landscape. Market fluctuations, where prices rise and fall, are completely normal and expected. Through this experience, I realized that the investors who ultimately succeed aren't those who manage to sidestep every downturn. Instead, they are the individuals who maintain their composure during turbulent times, keep their investments secure, and withstand the inevitable storms that come their way. The market tends to favor those who exhibit patience and resilience rather than those who react impulsively out of fear. In the long run, staying invested, even during challenging periods, often leads to greater rewards. In the beginning of my investment journey, I often allowed my emotions to dictate my financial choices. Driven by an overwhelming sense of greed, I found myself succumbing to the allure of trending stocks and the hype surrounding certain investments, only to realize later that my decisions were impulsive. Similarly, whenever the market experienced a dip, fear would take hold of me, compelling me to sell my holdings to mitigate potential losses. This continual cycle of emotional trading ultimately cost me a significant amount of money. What I've come to understand is that emotions are a formidable enemy when it comes to accumulating long-term wealth. Successful investors distinguish themselves by refraining from allowing feelings to cloud their judgment. Instead, they adhere to well-structured plans grounded in research and analysis. Once I took the time to develop a comprehensive investing strategy, detailing my goals and the parameters for buying and selling, and committed to following it rigorously, I began to see a positive shift in my financial outcomes. Time and again, my newfound consistency proved to be a formidable counter to the panic and anxiety I once felt during market fluctuations. By sticking to my strategy, I was able to navigate the ups and downs of the market with greater confidence and clarity. I once believed that I had achieved a well-diversified investment strategy simply by owning a variety of stocks from different companies. However, I soon realized that true diversification is far more nuanced and involves spreading your investments across multiple asset classes such as stocks, bonds, real estate, and cash reserves. It's also essential to diversify geographically and within various industries. For example, I focused predominantly on the tech sector, believing that the rapid growth of companies in this field would safeguard my financial future. Unfortunately, when the tech bubble eventually burst, my entire portfolio took a significant hit, resulting in substantial losses. This painful experience taught me a crucial lesson. Investing heavily in a single sector can be perilous. To mitigate risk effectively, it's vital to build a well-rounded portfolio that includes a mix of asset types. Allocating some funds to government and corporate bonds can provide stability, while real estate investments can yield rental income and appreciate over time. Additionally, maintaining some liquidity in cash can offer both security and the flexibility to seize new investment opportunities as they arise. Ultimately, by spreading out risk across various assets, sectors, and regions, you can safeguard your investments against the unpredictability of the market, enhance your potential for long-term growth, and weather economic storms more effectively. For a considerable period, my investment strategy revolved solely around selecting specific assets, be it stocks, cryptocurrencies, or mutual funds. However, I never took the time to reflect on the underlying reasons behind my investment decisions. Why was I investing in the first place? Was it to achieve financial independence, to purchase my dream home, or perhaps to retire early and enjoy life on my own terms? Once I gained clarity on these questions, everything about my financial journey began to transform. Understanding my end goals infused my investment choices with purpose and direction. I found that I could release the overwhelming pressure of trying to time the market or chase after fleeting trends that seem to dominate social media and investment news. I came to a vital realization. It's not about pinpointing the ideal moment to buy. It's about committing to the market for the long haul. I discovered that when investing becomes ingrained as a consistent habit rather than a sporadic activity, I was truly laying the groundwork for my financial future. It shifted from being a stressful task to an essential part of my financial life, setting me firmly on the path toward lasting wealth and security. Here's the hard truth I wish someone had told me. There will never be a perfect moment. The market won't feel safe. You'll never feel ready. But the longer you wait, the more time you lose, and in investing, time is everything. So start small. Start scared. Just start. Because the only thing worse than making mistakes is doing nothing at all. And if you're watching this right now, you're already ahead. Most people never even try, but you're learning, you're growing, and you're building a future that your older self will thank you for. This is Wealth Wisdom, where we turn knowledge into action and action into freedom. Don't forget to like, subscribe, and share this with someone who needs to hear it. Until next time, invest smart, stay patient, and keep building.